The crash of 2008 will pale in comparison to what's on the horizon. Recently, the United Nations published an article that said policymakers may induce a recession worse than the 2008 crash. It claims that the global economy will continue to stagnate and inflation will persist unless changes are made to monetary and fiscal policies. Regardless, if you are prepared when these kinds of warnings come and you can weather the storm of tough economic times, you will be able to get through the recession much better than the average person. Along with the UN's warning, a warning has also been issued by Credit Suisse, one of the largest and most prominent banks in the world. From what they've described, it appears they may soon run out of cash. Their future viability and stability could be jeopardized depending on the decisions they make. Hi, and welcome back to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. The economy is heading into a major shift. How will it affect you? What precautions can you take? Be prepared because no one is preparing you for what's on the horizon. The crash of 2008 pales in comparison. But before we begin, make sure to like this video, subscribe, and click on the notification bell to stay updated with our videos. Now, let's get to the video proper. The UN issued a stern warning regarding the worldwide economic crisis, claiming that increased interest rates will cause developing economies to experience a cascade of debts, healthcare, and environmental issues. They also asserted that we risk losing about $17 trillion worth of productivity and that our economy is on a downward trajectory to pre-COVID levels. While these events occur in conjunction with the recession, the United States is condemning central banks for trying to derail growth through unexpectedly high interest rates that have made life much more difficult for people already struggling with huge debts. Since many nations, organizations, and individuals are heavily indebted and reliant on historically low interest rates, they claim that the globe is witnessing a debt crisis. As we work to stabilize interest rates, we now have to bear the costs of inflation and historically low interest rates that are currently in place for the past 14 years. Moreover, it's generating a worldwide recession and potential stagflation, all of which might seriously harm our economies and people, and perhaps even worsen climate change and our health. At the same time, debt is a crucial issue that has to be discussed. It is estimated that 30% of emerging markets and 60% of low-income nations are on the edge of encountering financial difficulties. Since most of the world is already in debt, raising interest rates will have devastating effects. Thus, they are urging governments and financial institutions against doing so. Now let's go back to Credit Suisse. Although they have had debt issues in the past, they are not warning others about the current debt crisis. So to give some background, Credit Suisse got into serious problems after making a series of poor acquisitions. Some of their investments in failing hedge funds were funded by debt. They financed the risky investments with failing debts, which led to insolvency and a huge loss. Following heavy losses, investors started selling their Credit Suisse shares. As a result, Credit Suisse shares dropped by more than 70% in the last 5 years. In addition, they've also announced plans to raise money through the issuance of more debt and possibly even stocks. Credit Suisse has made a number of poor investment decisions, and as a result, the cost of servicing its debt is increasing, prompting more debt payments. What does this entail for Credit Suisse then? Credit Suisse's CEO issued a statement assuring shareholders that the firm has a solid capital base and ample liquidity amid the market's volatility and credit default swaps. If you remember the events around the 2008 crisis, you'll realize that credit default swaps played a significant role. Credit default swaps were a form of insurance, nothing more. As a result, during the 2008 financial crisis, these swaps protected investors from the potential collapse of a financial institution or a mortgage. And just recently, there has been a rise in credit default swaps involving Credit Suisse. Concerned that Credit Suisse would go bankrupt due to a lack of capital, people have begun buying insurance against the institution. However, Credit Suisse has made a really unusual comment about their current efforts to obtain more money. Credit Suisse has taken a lot of heat for its plans to expand debt and sell additional shares to generate cash at a lower and diluted share price, despite its insistence that it has no liquidity issues or money problems. To put it another way, they are saying they are willing to lessen the value of your shares so they can make more money overall. They also issued a statement addressing the fact that many investors would question why the bank needed to seek capital if solvency was not an issue. However, Credit Suisse remarked that the real motive was to change the negative perception of investors. Credit Suisse claims they need to raise capital not because of financial troubles or solvency concerns, but to reassure investors that they are still making a profit and have plenty of money on hand. Now, let's head on to the United States, wherein we saw a decrease of 1.1 million job openings in August as compared to July. However, the effects of inflation are felt by a growing number of people as interest rates rise. In the early stages of this recession, stagflation may possibly be to blame. Does this mean more people got jobs so more jobs are taken and the remaining few have better employment prospects? Or companies don't want to hire new people while the economy is still in a downturn? This report has received varying reactions and interpretations. Some individuals speculated that this might indicate that there are more people with jobs, while others suggested that it might indicate that more people are finding work or that businesses are cutting back on hiring. This is one of the things the Federal Reserve Bank looks at. They study the jobs report in great detail and with considerable transparency. More specifically, the number of positions offered, since there were previously 2 job posts for every applicant, which is an extremely high ratio. One of the reasons the Federal Reserve Bank sought to moderate the labor market was to have fewer job postings per job applicant. They argued that there needed to be more layoffs because the labor market was too strong. Similarly, they used this as a reason to continue raising interest rates. According to the most recent job report, there are currently 1.67% available positions for every job applicant. Although still relatively high, the Fed may use this as further ammunition to argue that we can still effectively battle inflation with the tools we now have at our disposal. Consequently, businesses, the UN, as well as some investors all believe that the Fed should stop battling inflation so aggressively since it is harming the economy, the world, individuals, and investments. Nevertheless, inflation continues to be at all-time highs. Since then, many have been wondering what the Fed is out to do. Do we wish to experience a currency collapse and economic crisis? The Federal Reserve System must make a choice. Which is worse? The severe cost of a recession right now, or the potential cost of a currency crisis in the future because of high inflation? Before its meeting in the first week of November, the Federal Reserve Bank must decide which of these 2 choices to pursue. Therefore, you should give this a lot of thought. One such moment is when you realize that you want to be the person who makes the most of the opportunities presented to them. This includes looking for opportunities and investing in markets, stocks, real estate, commodities, and even cryptocurrency. If you have the means and the knowledge, you can take advantage of the drop in asset prices and make a purchase. After learning to control and manage your finances, the next aspect of your financial situation that you need to pay attention to is your income. The last thing you want to do is spend the rest of your life in poverty, so you have to concentrate on increasing your financial stability. Even while you try to stay within your financial means, you don't want to do that for the rest of your life. That's all for this video. If you enjoyed it, please like, subscribe, and hit the notification bell to stay up to date on our videos. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. Stay safe and keep learning. Until next time!